Buy the hammer at support, sell the shooting star at resistance. Almost every trading account online teaches this, and almost none have tested it. So I did, on years of gold, and this time you get to see the trades. One of the filters everybody adds even looked like it worked, right up until I tried to break it. So what counts? Price has to come down into a level rather than drift onto it, and the candle has to close back above that level with a long wick underneath. That wick is the rejection. Every chart after this is one of those, on gold, at a real level, on a real date. Start with the trade exactly as it gets taught. Buy the close, stop under the wick, take profit the same distance away. Here is one that worked. Price slides into the low of the session, the wick throws it back. You buy the close, and it pays out before anything else happens. Here is the same trade a couple of months earlier. Same shape, same slide into yesterday's low, same entry on the close. This time, price never leaves the wick behind, it just sits under it and comes back for the stop. Neither of those is a lucky pick. For every pair in this video, the chart is the middle one of its group, chosen on the size of the wick before anything about the outcome was looked at, and no chart gets used twice. Across every time frame I have, roughly half reach the target and the rest do not. It did not blow up, it just did not do anything. So if the entry was not the problem, maybe the exit was. My instinct was to tighten the stop. If price gives the rejection back straight away, the trade is probably already wrong, so why pay for all that room under the wick? Watch what a stop just under the entry does here. Ordinary noise takes it out, and then the trade goes exactly where you thought it would go. So I went the other way and left more room than the wick, in case price sweeps again before it goes. Mostly it does not rescue anything. It just makes the loss bigger, like this one. Tightening the stop was the worst thing I did all study. Widening it stopped the bleeding and did nothing else. Then I wondered whether I was cutting the good ones short, so instead of taking profit at my risk, I held for triple. When one of these runs, it really runs, and that is the trade everybody remembers. But here is the other half of the same decision. The first target was there, you passed on it, and price came back through the entry for the stop instead. The hit rate falls about as fast as the payoff climbs, so the bigger target edges ahead by nothing worth having. Then the thing everybody asks about. Wait for a close back above the candle's high before you take it, so you know buyers are showing up. Sometimes that close never comes at all. You never take the trade, and the trade you skipped was a loser. That is the case for waiting, and it is real. And sometimes it comes late. Here the confirmation close is already most of the way to where you are going. Same idea, worse price, wider risk, and the win goes to the people who took it on the close. Waiting throws away nearly half the setups, and the ones you keep are no better than the ones you skipped. Then whether the level itself mattered. Last week's low came out best of the set, and this is one that held. And this is yesterday's low, the one every book names, which came out worst of all of them. Straight through it. A couple of levels did finish ahead, but the best of them had barely a couple of dozen trades behind it, and once you count how many different things I had already tried, none of them stand up. Then volume, because that is the other thing people add. Heavy volume on the wick is supposed to mean real money showed up, and a quiet one is supposed to be noise. This one is quiet. Nothing about the bar stands out at all, and it works. This one is the opposite. Well above its own recent normal, the bar people screenshot, and it fails. Split the whole sample that way, and it comes out the wrong way round, at every target I tried. And then the filter I was sure would fix it. Only take the trade when the bigger trend agrees, with the moving averages stacked in order, and it worked. Trades taken while the market was clearly going somewhere came out ahead, like this one, and the losers were the ones taken while the averages were tangled. That is exactly the kind of result people build a strategy on. So before I trusted it, I tried to break it. Same rule, same market, the years I had not looked at yet. Here is one of those, same picture, opposite ending. I gave it 3 times more data and it got weaker instead of stronger. I split gold in half by date, found it in the first half, then applied the same rule to the second half, and it flipped sign. Then I ran it on the Euro, the DAX and the Nikkei without changing anything, and across thousands more trades it ran backwards. So it was never there, it was curve fitting in one lucky window. So the pattern is real. It is just not an edge on its own, and none of the usual additions changed that. The candle mattered least, where the stop went mattered more, and the filter that finally looked like an answer was curve fitting. The levels themselves are next. Subscribe if you want to see whether anything survives.